Before we get started with today's show, I just want to take a couple minutes to talk about permissionless for the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. Be sure to act real quick there to get the best deal. All right, back to the show. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. All right, everybody, welcome back to another episode of Forward Guidance. And joining me today is Citrini, who I got to say, you're probably one of the most requested guests to get on this podcast. So it's really great to finally have you on. James, how are you?
I'm doing great, and it's always funny when either speaking to Jack or with you that's the case now, because I remember the first time when I came on, it was like right after 2022, everyone was like super bearish on tech, and then I came on and I was like, I think you should buy semiconductors because of AI, and it was like I think it got like 9,000 views, like nothing, and all the comments were like, this guy's an idiot. So it's always really funny when I hear that that's the case.
But yeah, super excited to get you on the show. I want to start the conversation by digging into a recent piece you published where you had this really interesting framework for how to think about Trump and the macro situation and the trade war, which is really by digging into what are the constraints to different parties as opposed to focusing on their preferences of what they would prefer. And I believe you published this right before we got the announcement of the China trade pause, the 90-day pause. Correct me if I'm wrong, but regardless, overall, that set you up nicely to understand that the off-ramp was going to continue more than even what the market expected. So I would love for you to just set the stage by how you thought and came up with this framework. Where did it get you? And then where are we today in terms of, obviously, the call within that piece was that the market was overweighting this potential of a recession versus what's likely. So yeah, how did you get to this stage of this framework?
Ever since kind of Liberation Day, the view has generally been this is a generational inflection point, but it's contingent on like one dude. And the salient point of that is Trump has constraints just like anyone else. No matter how much he wanted to say, the market's got to take your medicine or whatever. And obviously the market had to price in those risks. And we basically just created a massive wall of worry that forgot about the fact that they probably don't want to cause a recession. They definitely don't want to cause stagflation, right? Because eventually you get bullied by the market. There are things that the market can do no matter what that will force policy. With that piece, I basically wanted to kind of share some thoughts on where the economy was, because we started to get the initial looks at how companies and consumers were doing. And it's kind of, the first thing is the labor market definitively has cooled, right? Job openings dropped to like 4.5%. Waller has been warning that could lead to rising unemployment. But the important context was that, that cooling in the labor market happened primarily through decreased job openings rather than like mass layoffs. And a lot of the stuff that people point to as evidence of like widespread economic weakness is still just like normalization to pre-COVID levels, even like credit card delinquencies. It's just like the COVID kind of bump has worn out. But then on the other side, this is kind of the zenith of something that's been happening for a while, where it's when the soft data, hard data thing, which it's like for the past 2 years, it's like you speak to a business and you're like, how do you feel about the economic environment? And they'll say, oh God, this is the worst it's ever been. And then you say, well, how'd you do? And they say, well, we had the best year we've ever had in history last year. It's like this disconnect between like the sentiment of everyone about the economy and the future of the economy versus the actual data. And the tariff stuff kind of supercharged that, where companies kind of had to scramble. A lot of companies were like existentially threatened by this. So our view after tariffs was, if these stay unchanged, this is going to be a very bad recession, but they're not going to stay unchanged. Like the market will force a change to this. And, we got a pretty good masterclass from COVID on, how businesses act in preparation for supply chain disruptions. This isn't COVID where it's like everyone's caught off guard. Like companies have been preparing for potential tariffs for quite a while, and you see the import data from March. It's one of the craziest charts I've ever seen, which is the pharmaceutical imports jumping 71% month over month, like $13 billion in inventory added, like triple digit percentage gains in organic chemicals. So that was an interesting thing of looking at, like, the retailers didn't do too much of that, but some areas did. So we categorize Trump's constraints into three areas, which is debt refinancing needs, right? You got like I don't know, around $8 trillion of U.S. federal debt coming due between April and June. And then Dario Perkins kind of made the comparison of the UK's war on premium during like the Liz Truss LDI stuff to what was happening in the US. And I think we've seen that pretty demonstrably in bond yields. And then you get the tax bill priorities, right? The administration really needs Republicans in Congress to be unified, because as much as it seems like it, they don't want to, like, Scott Bessent has said his like three-legged stool, right? Which is basically trade policy, tax policy, and then deregulation, right? So the entire narrative for the past couple of months has just been trade policy. The administration doesn't want that. And I think the biggest kind of signal and part of the reason why we got a little bit more comfortable with the upside narrative was, like, there was a report that Trump himself said, "I don't want to be Herbert Hoover." So, it's one thing to say, oh, this guy is doing these crazy tariffs and he doesn't even know how bad it is, and he's just going to go through with it, versus you have a guy who like recognizes that it could get really bad and is aware of like what happened with Smoot Hawley. And so this three-legged stool, that's kind of like, as we the signal from the, it's not a concrete trade deal, but it's a big signal that where the administration's priorities are, and they're shifting away from trade policy and towards the focus on tax cuts and deregulation. So my view right now is where on like and again, the reason why I do macro is because is to like inform my kind of view of trends and themes, and there are a lot more talented macro engineers than I, and I kind of just my trading of like FX, short-term interest rates, like commodities, it's all just like I showing up when I think there's a really big opportunity, and otherwise I stay out, because I don't really want to put myself in a situation where I'm like fighting with basis points over guys with like $10 million models of the economy. But what I see happening right now is the Fed's in like a pretty difficult balancing act. Disinflation still is trying, like you saw, there was like some moderate pass through to goods inflation in the last CPI, but like it was all kind of canceled out by services disinflation. So there's a strong case for the Fed to resume cutting in June. They kind of hesitated at their last meeting. They mentioned stagflation a bunch of times. That was uncomfortable, but my view is that they're more likely than the market expects to cut rates in June. I think that they'll probably, like, after seeing the progress with the Chinese talks, that they're going to be just like any other market participant and start responding a bit more accurately. And I think that we're in this crucial kind of 2-month window where pretty reasonably significant progress on trade deals is likely. We're still in the window, like the inventory stock up has not been run through. There, both sides here, with the U.S. and China, have strong incentives to find an off ramp, which is what we saw happen with these Swiss stocks. So maybe we see a month of like economic slowdown or like even like technical negative growth, but I don't think that the economy is too good right now for like a full blown recession. Yeah, but mainly the main concern there is rates, which is if the long end keeps blowing out, then that gets a little bit trickier, right?
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. Based on that framework and where we're at, where obviously there's this window where we can, move forward and see significant progress with these tariffs. And my last question for you on the macro side of things before we dive into the specific subsectors that you're excited about is, I've seen a few napkin maths of where we're at on the effective tariff rate, and it sits at somewhere around 12.5% or something like that. And obviously, there's the opportunity for that to decrease further. But are you of the mind that at this juncture of where we're at now in the effective tariff rate, it's pretty unlikely we're going to, there's very little risk of a recession at this juncture, and it's something that the economies can mostly look through and adjust, change up where they get their supply chains from and that sort of thing?
I would say you have to qualify it with just, again, if you just listen to Scott Bessent speak, this kind of three-legged stool, that the answer to that question is going to be dependent on the progress that they make with tax cuts and deregulation. The deregulation side has been super opaque. I don't think, I haven't really spoken with anyone that knows what the administration's specific deregulation agenda is, but we did get like the one big beautiful bill. So that's like $5 trillion in net tax cuts over 10 years. And the thing, we wrote an article in 2023 that was titled U.S. Fiscal Primacy. And we wrote it with Steve Ho and Steve Moran. So two whole Steves, right? And our kind of thesis there was pretty simple, which is just every dollar of deficit spending ends up as a dollar of corporate profits. And that's not distributed evenly. So you have to really pay attention to spending bills to find out where this money goes. And if you do that, you can have a pretty significant policy edge in equities. So with the Inflation Reduction Act, that was much more focused on areas like specifically the domestic component requirement. There was there was big kind of industrial electrification push, and some of those names were very easy because they had data center upside as well. So now I would urge kind of, if you're an investor, trade like we all we're all to some degree trade policy experts, by not by choice but by necessity over the past couple months. I would say that it seems pretty clear that the administration wants the market to focus more on their tax bill, their spending plan, their deregulation initiatives, and I do see an environment where, as long as trade deals continue progressing, we see the headline cycle kind of shift more towards that. Could there be like a massive blow up? Absolutely. Like that's kind of like so I would say on the cautious side, whenever like equity protection looks cheap, I'm a buyer, because on the other side, there's a lot of upside, because we had at least a degree of a wall of worry, and the economy's still pretty good. And if we get out of this, it's there's just deregulation and tax cuts and government spending to go, and that's great. We've seen how great that is. That's what kept us out of a recession in 2022. So the one big beautiful bill, which is like a real mouthful. I liked Build Back Better was much easier to say, but so the key kind of government revenue reductions were basically like they're making permanent the TCJA's individual rates, top rate at 37%. Those otherwise would have reverted at the end of 2025. That was easy. Everyone knew that he was going to extend the TCJA, and there's no taxation on tips or overtime income. That's like conservatively $25 billion of like per year in money that's going towards service industry workers. And then there's also no certainty yet, but the state and local tax deduction. They're paying for it with repealing the green energy tax credit. So you got to, but the interesting thing about that is like so much of that anything that's widely expected in this bill has pretty much already been priced in, right? So that's why you look at something like First Solar, which was a huge IRA beneficiary, and then has basically been just getting slammed by negative catalyst after negative catalyst, and has pretty much already priced in the tax credit repeal. And then the other interesting thing is for as far as the offsets is they're going to be doing like a 5% tax basically on offshore remittances. So like if someone is in the country and they want to send it, let's say someone's here from Mexico, they want to send money back home, that's going to be like taxed at 5%. And then if they're a citizen, they get the refund on their they get a tax refund for it, and if they're not, they don't. So and then they're paying for it with they propose Medicaid cuts and SNAP cuts. So as the spending plan kind of like we've got basically the proposal of the tax plan, it'll be pretty contentious because there's still a lot of like deficit reduction kind of centric Republicans, and they really need all the Republicans to vote for this for it to pass. So. But that's going to be what, in my opinion at least, that's going to be more what dominates the narrative going forward. And the skinny budget, that's like I think it was like a 2.6% increase for 2026 in spending, but like beneath that top line is like a pretty significant shift, right? Which is just massive cuts to social services, offset by like very substantial increases to defense and homeland security, which is hysterical because most people that you spoke to over the past like 3 months were like, no, like Elon Musk he's gonna cut the deficit, it's like, and so many stocks basically were like, oh, this is a beneficiary of government spending, done, just like sell, and now they're like announcing a huge increase in like defense spending, and it's the exact stocks that everyone just sold because they thought that Elon Musk was going to like the interesting thing is like this bill is much more, or the spending priorities, it looks a lot more like a wartime bill than like a peacetime bill. And it's directly connected to his geopolitical and economic agenda. So like you have tariffs that again, tariffs can be good. It's possible, right? Like if you remember before that chart came out, 10% tariffs were announced, markets started ripping, right? Like 10% blanket tariffs, it was like the best thing in the world. So it's kind of like if we get closer to that level, that kind of takes away where it's like, why should we be lower than we were before Liberation Day? Some people say because you have to price in the risk premium of like Trump being a maniac. And that was kind of my view for a little while. But then if you know that Trump's a maniac, but he's beholden to these constraints and these market forces, that risk premium gets a lot less. And then you have to take into account that between like 6,200 and 5,600 on S&P, we were pricing in some degree of that. Really, one of the areas that like Citrini Research has really been focused on is that if you although it's super painful, if you actually read government policy, again, really annoying to do, but there is alpha there. And the three kind of key investment areas for that spending bill is so there's like the Golden Dome, right, which is like missile defense, $12 billion for like next generation interceptors in Alaska. Then there's naval dominance. So the shipbuilders become pretty interesting. There's an interesting anecdote about like the Ottoman Empire in Venice. Or wait, sorry, maybe it was the Byzantines like outsourced their shipbuilding to Venice. And Venice, delivers the ships, and then 3 years later they get into a war, and Venice just absolutely murders them because, you need to do your defense stuff, kind of quote unquote in house. So that's kind of, I think, how they're thinking about shipbuilding. The U.S. has had naval superiority for decades, but our industrial capacity to produce new ships is like totally stagnant. And currently shipbuilding makes up like 1.3% of the defense budget. So this is a pretty, pretty big change. And then the other thing is like this kind of these like national heroes, like Trump awarding the F-47 fighter jet to Boeing. It's and a pretty substantial investment in drone technology, where basically anywhere where the U.S. has lagged behind China becomes an investment priority. There will be pretty significant hurdles to the budget in Congress, but the direction is clear. Like defense priorities are probably going to survive that political gauntlet, even if like some spending cuts are softened. We might not see like the whole big beautiful bill, but there's areas where like there are no more China doves left in the government. So really focusing on those areas, and that's kind of where I've been focusing on in equities.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the number one institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure notes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ondo.finance, and see how they're bringing capital markets on-chain. Restrictions apply. That's really interesting. It sounds too like the market is also at this interesting point of tension that is deep within your wheelhouse of like thematic long short equity, because like you were saying a few months ago, everybody was all on the side of basically long austerity, long DOGE, and this idea of pulling back and narrowing fiscal deficits. But what we're seeing now is that the likelihood is actually going to be this complete 180. So it sounds like the market is at an interesting moment of tension to be able to express those long short views that you just mentioned. Hey.
Yeah, and I always I really enjoy it when a theme has like multiple kind of trends that are supporting it. That's kind of the framework. The things you need for like a successful equity theme are the macro environment has to be correct. You have to have like a convergence of trends in the real world, and then of course you have to have investor kind of interest in the theme. So the last couple things that we published, the most recent thematic kind of primer that we published was on where AI is going to go from here. And the idea is like in 2023, when we published our AI piece, our first AI primer, we went over the idea that you don't know what AI is going to look like in 5 years. So but you do know that, or we knew that AI would be a technology that would proliferate and be transformative. So the best way to position for that was AI infrastructure, and that caught on very quickly, and picks and shovels became like the consensus view. And the thing about that is like now we're at the level where we're still going to build AI infrastructure, and scaling laws still are real, but it's kind of like a put up or shut up moment where AI has to start really genuinely generating revenue or margin improvements, and we need to see like a bigger kind of proliferation of use cases, and people and companies actually utilizing it to make real world changes. So that is where we're positioned on AI, and then you get the what we just spoke about, which is anywhere where we're kind of lagging behind China is going to be a focus for government spending, and you know, we have pretty big pockets, and there's not insignificant amount of investment coming into the U.S. So that kind of leads to the natural conclusion of like, where do these two things meet up? Where does AI in the real world and focusing on where we're lagging behind China kind of converge? It's in robotics, and that's pretty interesting to me, because I've obviously, since AI became a thing, it's when you think about, 10 years ago, you think about artificial intelligence, you're probably going to end up thinking about like this human robot that's just like, like Star Wars kind of stuff, and we're going to get there, right? Like robots are going to be, we are always going to make more robots. That's a trend that's not going to change. But right now in the market landscape, most companies with upside to robotics are also exposed to the automotive cycle. So how do the automotive cycle has been absolute garbage. and the most interesting thing for me, which is why I've been tracking this theme, is because the best themes are not, it's not just, oh, everyone suddenly cares about this thing, right? The best themes are when you have a sector that is like cyclically screwed and has a secular story that can emerge. Like any company that's close to like a cyclical bottom, or and has gone through a really rough kind of cycle, and also has the potential to re-rate on a secular narrative, that those are the best themes in the world. And we saw that with AI, right? I mean, if you remember, at the end of 2021, nobody would touch NVIDIA because of like the crypto GPU glut and the double ordering, and there were a million reasons why NVIDIA should have traded at, I don't know what it was, 5 times the next 12 months earnings after it, once they actually came in. But then you had ChatGPT in November, and it was like, well, this is a pretty forgiving multiple, and if this is a real kind of trend that people start caring about, that re-rating is going to be amazing, and that's what happens. So the framework is always try to buy secular stories at cyclical prices. It sounds trite, but it's true that's generally where your best returns come from in thematic investing. So with robots, the robotics supply chain is obviously very exposed to that automotive cycle, and we've seen it in the numbers. But recently, you've got Microchip Technology came out, and their CEO literally said the March quarter revenue decline marks the bottom of the downturn. That's a verbatim quote. Infineon said end markets have bottomed. Regal Rexnord it was confident enough to reaffirm their full year guide. They even modeling out like EBITDA neutral tariff mitigation. onsemi said that Q1 was bouncing along the cyclical bottom. So what I see there is this is an area where we are the U.S. is super far behind. Like most of the robotics breakthroughs are coming from China. Especially in terms of cost, right? So if you look at like the major players, China's Unitree has a humanoid robot that they're selling for 16 grand, and I know that everyone's like, this is CGI. It's not CGI. I'm just telling you, it's not CGI. It's real. I've seen it. It's cool. And when you look at that, it's like, okay, well, when a humanoid robot starts like dipping below the cost of like a used Honda Civic, that's a pretty interesting dynamic, because while like if you design a robot to specifically mow your lawn, you don't really necessarily want it to be a humanoid, but if you want that robot to be able to mow your lawn and then like come into your house and do your dishes, the world's interaction layer is designed for kind of human, like 4 limbs, 10 fingers. It's designed for human interaction. So I think it's a pretty interesting time to position yourself for. You say, well, like the inevitable future is that we will have humanoid robots, and kind of do the same thing with that one would do with the AI trade, which is just, I'm going to position for the companies that have upside, because right now the valuations are forgiving, and maybe that's not the case in a year. Maybe the rollout of robotics, whether it's quadrupeds or Tesla has the Optimus and gets it down to a normal thing, or it's Unitree and we're importing them, but we're slapping modules and cybersecurity on the back and trying to catch up. It's a reasonable time to get kind of positioned for it. So we're published a piece that kind of goes through. We straight up tore down Unitree robot, like not the I wasn't not the 16 grand one, but one of the kind of like dog robots, and just looked and we went pretty in depth. But one of the more interesting parts for me was, if I asked you, like, what do you think the most expensive part of a robot is, what would your answer be?
The chip.
See that? Yeah, that's what I thought too, right? But so Nvidia's Jetson, the like brain of these robots, $60.
Wow.
$60. And so like in the little dog robot, like 66% is coming from like the actuators and like the joints and the screws. The chip is actually super low, and Nvidia has made pretty significant robotics investments. And the crazy thing is, like, they have this thing called Isaac Sim. If you want to like feel like it's the future, like just like go into a little sci-fi hole, you can go check it out. It's totally free. Any developer can just like go and basically, instead of like, there's a limited amount, there's a ton of training. When you think about like a large language model, ton of training data, right? Humans have been writing for thousands of years, right? So we have a ton of training data for writing. There's not that much training data for like motion and movement and like being a human, but you can take your model robot or whatever and train it in the simulation, and it'll basically train like 10,000 hours of being a robot in like, an hour. And it'll go through a bunch of different, like, it'll change the domain, it'll change how the lighting goes, and so you can just like go train a robot, and you can train it to do like, I don't know, like 80% of things, and then like the other 20%. This is like kind of the interesting, like, we'll like come full circle back to macro, because we didn't go too deep into like what macro would look like if we had a bunch of robots, but
Yeah, I was going to ask about that, because I remember you wrote a piece talking about the potential for like a white collar recession driven by these ideas of ChatGPT and stuff taking out, software developer jobs and stuff. But then you're starting to talk about robotics. First thing that my head goes to is, okay, that's sort of the other side of the working class too, of just like these regular, like self-driving car type of things. So yeah, what are the implications there?
yeah, so that's the thing. It's this is why we didn't write a ton about like what is the macro impact of artificial intelligence yet, just because it's like there'll be a time and a place for that, and it'll be when it starts showing up in the data. But it's super interesting to talk about, where it's like, okay, so like what are the industries so far that have gotten actually disrupted from AI? I would say that at the top of that list is BPOs and call centers, right? Like you can the technology. I could run a call center on my cell phone right now. But every time you look through history, and it's like there's a new technology, and everyone says, "Oh God, this is going to make everyone unemployed," and then everyone isn't unemployed. Like whether it's the loom, or like textile manufacturing, or with like the Luddites, or Excel, right? Excel was supposed to put every single actuary out of business, and it just doesn't, because humans adapt. And so the interesting thing is, like, you have all these call centers, and like the call center business is just like it seems absolutely screwed. But most of these are in India. Labor in India is like I don't know, $400 a month, and you have these humanoid robots that cost 16 grand, and they have hands, and they can interact with the world, and probably, like I said, you can simulate probably 80% of environments, and like in structured environments. But like in my house, like my house has a spiral staircase, and it's a pretty unique one, and I don't think that the robot has training to go up my spiral staircase, right? So what I see, and this is like a super contentious point, because most people that are like running robotics companies are really like all or nothing, autonomous robot, got to do it. But when you think about like the safety implications, and kind of regulation, like, and also the fact that like labor arbitrage has been the driving fact for industrial capitalism for like at least a few decades now. I think that a lot of those call centers are just going to turn into like centers for like these kind of like teleoperated robot pilots. And you're gonna have companies that have like robotics as a service, where you pay a subscription for like $500 a month, and there's a humanoid robot that will just kind of like do your dishes, and or like mow your lawn, or vacuum, or whatever. And one robot can do all those things, because again, the world is designed for human interaction. And there will be a pilot, and maybe in the beginning, half the time that robot's active, it'll have to be piloted. And as the AI technology gets even better and better, that'll go down and down and down, and eventually you'll have one guy in India that's just like piloting 100 robots, because each one, it's like for every 24 hours, it needs 10 minutes of intervention. So I think that there are like pretty significant macro impacts to that. But I'm much more focused on like the fact that this is a real thing. The robots are coming, and they have been coming, and the time to invest, I think personally, is now, because I don't think the valuations will get much more forgiving than this.
So obviously, coincident with this interview, you are releasing a new robotics primary thesis piece on your research website, and Yeah, I would love to just hear if there's anything you can share there in terms of specific either companies, themes, or ways to think about how to evaluate how to get exposure to this subsector if the time is now, as you say.
So yeah, so the interesting thing is like we did like the breakdown of materials, the bomb, and kind of extrapolated from like this is the breakdown of materials with the dog, and like the biggest question for us is like, like a Tesla Optimus robot is each one of those is like a Ferrari in terms of cost. So seeing this robot, even though it's like a little shorter than a Tesla Optimus, it's like the battery life is probably a little shorter, but like seeing it at 16 grand was kind of like, the first reaction obviously is like, well, this is fake. And then we just like went through it, talked to a sales rep, like it's real. And then obviously the thing that we had to wait for was like, well, if there's 145% tariffs on China, this doesn't really matter. But there's not anymore, we think, hopefully. So the real main kind of insight is that the cost is really in the movement, right? The like making the hand, right? The dexterous hand, or like the shoulder joints. So you have company, and it's mostly dominated by China. There are plenty of Western companies that could do this, but they're much more expensive. And like I said, the administration's priority seems to be, we got to catch up to where China is beating us. So maybe we could see some pretty significant investments or subsidies for these kind of Western companies that are doing this. But right now, the way that China is set up is like, Unitree gets set up, and then they got to buy, like they'll buy their LiDAR stuff. They'll buy chips to go into the robot's brain. They'll buy, motion control chips and encoders. And then as far as like the rest of the stuff, they basically go like one level above like ore. And like there's like a 90-mile radius in Hangzhou where just like all their suppliers are, and they're just doing it in-house. And that's how they've gotten to that cost level. And if we don't want to fall behind on China to China and robotics, we're going to have to do that. And there are plenty of companies in the US that could do this and could get cost competitive. They just need pretty significant investment. So like one of my couple favorites, like Regal Rexnord or RBC Bearings, but this is a massive supply chain. So our piece is basically, we made 9 subcategories for just like how we did with AI. We made the subcategories. We took a universe of we went through all the depths, and we took a universe of like 225 names, categorized all of them, made commentary about them, and then like narrowed it down into like, here's the 25 names we think have the most upside. But I always like it when the theme that I'm working on is something that I could use. And like, honestly, man, I really, AI right now is like trying to like take over like the creative process. I don't need AI to do that. I don't need AI to write for me. I need AI to do my laundry, so hopefully we get there, because I think it's a really cool future, and hopefully they're autonomous, and but the bridge there matters just as much as the destination. And I think that anything that kind of gets this going is good. So that you really, and I'm sure there are a lot of people that are like doubting this in general, and the idea that like we're not going to have robots. I don't know why you would, because if you, over the past 100 years, if you read sci-fi and then you invest in tech that like matches what the sci-fi vision for the future is, you've killed it. You just murdered it.
Yeah.
So I think that it is more of an inevitability than a possibility, and it's just the timeline that matters. And the timeline is a function of like the cost curve and the macro environment. And yeah, so I think now is the time to position it. And if you're doubting, you can go and look at some of these, most of them are private. There are like holding companies that have stakes in some of these companies that we talk about, but go look at, Figure, or like there are humanoid robots in Amazon factories right now. Like as we're speaking, like they used to have the movable like pylons that just were like moving boxes around, but now there are digit robots in Amazon factories that are doing the work of humans. And Figure has videos where there's like a robot autonomously unpacking your groceries, and you look at that and you're like, well, anything that's autonomous can be teleoperated. So we can pretty like you could put a guy in here and have him operate this robot, and then I don't have to unpack my groceries anymore, and that's
Yeah.
pretty cool. I would pay
Yeah,
$500 a month for that.
I would do that too. I'm curious about how do you weight or prioritize whether to get exposure from China, who's way ahead of this, or focus on the US, especially within the context of bring it back to macro a little bit here is obviously within this China deal, we started to see some hints from President Trump talking about how China's willing to open up their market, and it's really interesting. And this we've seen a similar situation too with the AI, trade of DeepSeek coming online, and then if you're somebody who's trying to prioritize whether you prioritize investing on the Western side of things or the Chinese side of things, yeah, how do you think about prioritizing those two different worlds?
I think that if we're smart, like we will buy robots from China and focus on like controlling the brains, right? So like China dominates like actuators and joints and planetary screws. There are companies in the U.S. that can do it, and there are companies, especially in like Switzerland too, that can do it. But the U.S. owns the brains, right? Like Nvidia has Isaac and Groot and their Jetson, and Google has DeepMind Physics, and that like software mode. The fact that like if you want to train a robot to be like as good as possible, you're going to be doing it with Nvidia software. That's a pretty defensible thing, because you can always up the cybersecurity. You can always like route the connectivity. Just because China's like making these the chassis and the metal parts, like that's not worrying. I'm not like you're not. I'm not worried about having like a Chinese robot in my home if China's just responsible for like the stuff that moves, right? And then not the stuff that thinks and connects to the internet and all that stuff. So I do think that there's areas for cooperation here, and if the U.S. is smart and like wants to catch up, they will kind of do the same thing that China's done to the U.S. for a while, which is just like utilize the products to catch up. China's better than the U.S. at a lot of things that it didn't used to be better at, and that was a function of like they just kind of copied it and improved upon it. So I was just in China, and like I bought a Xiaomi phone, and it is insane. For like the display is nuts. If I was like sitting 10 feet away from you, I could zoom in so far that I could see your pores on the camera, and like the phone, like it folds in half, and even folded up, it's still thinner than my iPhone, and that cost me like $550. Whereas like Apple announced like a foldable iPhone, and it's going to cost like upwards of $2,000. Also, the priorities of like onshoring and stuff, like yeah, you should be able to build your own ships, and robots are a big part of that. The priority of like if the administration really does, I'm not like going to comment on whether this is like a good idea or not, but if they want to reduce the flow of immigration, again, robotics is a huge part of that. Like if we still want to have blueberries, I don't think there are like a ton of American workers that are lining up to like where the migrant laborers are in California. So I think that there will be maybe not price competition, but I think there will be competition, and hopefully we'll have cooperation. And for now, it's pretty clear who's winning, and it's pretty clear where the priority should be.
I'm curious about as you go through these technology themes, be it AI or robotics or anything like that. I remember, I think you tweeted a couple months ago about how ChatGPT and these AI LLM companies, if they were to be actually profitable, the prices would have to be so much higher. So it's sort of the similar situation that we were in with Uber and Airbnb 10 years ago, where they're intentionally keeping the costs low to increase their user base, and in reality they're sacrificing their margins. So yeah, I'm curious, how do you protect and identify how to silo off these as actual moats that are good for investing? Because obviously these are great for society. If we have robots that are doing our laundry, nobody's going to complain about that. But how do you protect against this idea of that being like a durable moat that doesn't just get eroded away?
Well, that's like where, it's like where you want to position in the theme. It's if you have like with like artificial intelligence, there's with like transformative new themes, and this will happen with robotics too, right? Like there's always a stage where like investor kind of like equity capital, basically like investments are basically subsidizing the user until the user base gets like comfortable with the technology. We saw it with Uber, and look now, like Uber's free cash flow positive. We've seen it with AWS and cloud. We have seen it with AI, and we will see it with robotics. So when you do that, it's kind of like when you decide when to kind of pivot from the infrastructure to the actual implementation, right? Like there's always the infrastructure build out, then the implementers, and then there's like the moonshots, and so right now, at this stage, the moat has to be like, well, nobody else can make this part as cheap, or nobody else can make this part as well, and then the idea of like, if you make someone reliant on something, right? Like if you were doing this podcast and somehow you, for the past 3 years, you've just been using ChatGPT to like conduct the podcast. Like, let's say I'm not actually talking to you right now. This is just like, this is like your avatar, and your avatar knows how you talk, and it's talking to me like, and then the price goes up by 200%, like you're going to pay that price increase, like, because otherwise you have to come back and do your job again. And, like, so yeah, you generally do in the beginning, you want to stay away from the companies that, they do the work to get the growth by subsidizing and the consumer. And then eventually there is a point where you want to overweight those relative to the infrastructure. And that happens relatively quickly. And normally there is a period of time where there's like a, hype cycle unwind in between those two things. But right now it's like, you just look at companies that like Regal Rexnord, for example, just like quoted that in the next year, they'll have $100 million opportunity from robotics, or $100 million in revenue. So you look at companies that have like small robotic segments, or maybe even big robotic segments that are seeing like huge growth relative to other segments, and that's where you position. And then the other thing is like making sure that you position with the core of this thesis is basically, A, I think the automotive cycle is bottomed. B, I think that robotics will eventually be ubiquitous, and that's inevitable. And C, I think that the trade policy narrative is kind of dying down. So even if robotics weren't a thing, I'd probably be looking at like buying companies like Regal Rexnord or Rockwell or ABB or SKF, like all these kinds of automotively exposed companies, and the chip names too, like Infineon and onsemi. But robotics are a thing. So if I can buy it, and like the tail of robotics that's priced in is super, super skinny, if I'm wrong about robotics, like the investment probably still turns out okay, because these companies are good companies, and like they're exposed to a cycle that's cycling. And then if robotics does become a thing, I'm gonna print money. So that's kind of how I think about it, where it's like a risk reward thing. And obviously the main kind of risk here would be like a broad industrial recession. But the crazy part about that is like, we just had an industrial recession, like in a lot of areas. A lot of these names are much more early cycle than late cycle. They're just coming out of a recession. So that seems reasonably like a margin of safety. But for the names that aren't like that, there's plenty of reasonable ways to hedge against recession. I still think that like if we have a massive recession over the next 12 months, rates are going to go down. So if you can hedge with like so for a year out, and that expects rates to still be 4% or 3 3/4, that's probably a decent hedge. And I'd rather take opportunities in macro to hedge against macro risks than completely stay out of opportunities in micro because of macro risks, if that makes sense.
Well said. Well, James, always an absolute fascinating journey of conversation we have you on. Really appreciate that. Where can folks go if they want to see more of your work and your research there?
Yeah, so this is coming out on Friday, and that'll be when we release our Citrini Research robotics primer. They can go to citriniresearch.com and sign up, and a certain portion of it will be free. So if they don't want to pay, they can still read some stuff, and if they do want to pay, it's pretty long, but I think it's very good.
Amazing. Well, thanks again for joining, Citrini. Always a pleasure.
Thanks a lot, Felix.